Good morning, everyone. Thank you for joining us on the webinar for tax-free retirement. I want to introduce BackNine Insurance, who recently partnered with us in order to provide additional financial services. They're a company that provides life insurance, annuities, long-term care, and disability income, and they have access to over 40 insurance carriers, which allows them to shop the best product to meet your financial goals. At this point, I would like to introduce Josh Elahim from BackNine, who will be speaking on tax-free retirement. Josh?
Thank you, Rod, very much. Appreciate the opportunity here. Just some quick homework here. Everyone's going to be muted for the purpose of the call here. If you have any questions, there is a chat box, or you can give Rod a call or send him an email, and we're here to help you out with anything you see you like or you have any further conversations. So without further ado, let's go ahead and get started here. Just a quick disclaimer. All right, let's have some quick fun here. Well, I think we've all seen this comment here before from Benjamin Franklin. Certainty in this world, nothing is certain but death and taxes. So what I wanted to do was just talk about the thing that probably drives us all the most crazy, and that's taxes. So if you take a look here, you'll see some of the increases in taxes that have happened since 2015. The top tax rates have gone up 4.6%. Medicare payroll tax has gone up 0.9%. Long-term care capital gains and qualified dividends have gone up 5%. And unearned income and Medicare contributions have gone up 3.8%. Your itemized deductions and personal exemptions have both been phased out. There's definitely been some changes. So the question is, how does this affect you when you retire? So Social Security is up to 85% of benefits could become taxable. And then your premiums could rise from $105 to $336 a month if your income is above $214,000 for Medicare premiums. So what we've noticed here was working with clients is that they typically have their money in one of these three buckets. The first, you have your tax-deferred bucket, your 401ks. Then you have your taxable bucket, so your stocks, your bonds, your mutual funds. And then you have your tax advantage bucket, so your Roth IRAs and muni bonds. So we firmly agree in these three buckets here. If someone's willing to match a 401k, you put a percentage of your money in there. If you're more aggressive, you can go into the stock market and you can, have some money there as well. What we've noticed though is that how are you going to be taxed on this money pre-59.5 all the way up to 70.5? Very, very important. A lot of our clients don't think about this. So if we look at how we're going to be taxed in these three buckets, at 59.5, we have ordinary income tax plus a 10% penalty. We also have the tax-deferred bucket becomes taxable. At age 62, too much modified adjustable gross income, 85% of Social Security benefits are taxed. And we also have Medicare Part B costs increased from $105 to $336 a month. But at 7.5, we have our RMDs add to your tax exposure as well, your required minimum distributions. So when we talk about taxes, you make all this money, and then all of a sudden when it comes time to pull it out, you have some surprises. You probably all know who this person is. Robert Kiyosaki said, how much money you make is how much you get to keep. So with saying that, the whole goal here is to show you a way that you can create non-reportable tax-free income. That's something you'd be interested in. Almost everyone's going to say, yes, that sounds very interesting. There's one more bucket that you might not be familiar with. And that bucket's called life insurance. Well, I thought life insurance was just for a death benefit. No, that's usually used for term insurance. There's a lot of different options here that can help out for retirement in terms of using a life insurance chassis. I always ask when I talk to clients, I always say, do you have the old kind of insurance or do you have the new kind? And they'll say, well, what do you mean? Well, the old kind of insurance is really just geared towards death. The new kind is geared towards what's called living benefits, and we'll go through that here in a little while as well. Let's do a little comparison, though, for how life insurance works at age 59.5 to 70.5. So at 59.5, you have an income tax-free distribution without penalties. You can access income tax refunds on most policies. At age 62, there's no effect on your Social Security benefits. At age 65, there's no effect on your Medicare Part B. At age 70.5, you're not required to take those minimum distributions like you are with the other investments we discussed. So a few other bells and whistles about life insurance. I won't go through all these, but you have a tax-deferred growth according to IRS Code Section 72E1. You also have tax-advantage distributions according to IRS Code Section 72E5C. The one that everyone likes the most at the bottom, you'll see, is the income tax-free death benefit. A lot of bells and whistles that life insurance can provide. And I have my joke that I always say is that people don't buy life insurance because it's sexy. They buy it because of the benefits. And that's what we're here talking about today, is the actual benefits. So what are some of the uses that we see in life insurance that are normal? Like we've talked about, we see a death benefit, maybe for funeral expenses, mortgage debt protection. But there's a host of other things that you can use life insurance for. I need 20 grand. I want to build retirement income, and I need some money to pull out. Well, these policies now are very, very flexible, and you can grow cash in there on a tax-deferred basis. So if you're listening on the line here and you're also a business owner, we're seeing several different ways to use life insurance for a business, whether it be a funded buy and sell agreement, whether it be for key man insurance. You have employees and you want to make sure your employees are taken care of. You can use it to recruit, and retain your current and future. There's a lot of different options that life insurance can be used for besides just the death benefit, which you've known it for in the past. So the strategy we're talking about today, again, is tax-free retirement. So we have kind of a little outline of who would be a good client for this. So anyone who's looking to save money for retirement is going to be a good candidate for what we're talking about today. An income range of around $250,000. I've seen clients, everyone's in California, but live in California here that make $1 million a year, but they also spend $1 million a year. So they don't really have any money to put away. Now, you could also make $100,000 a year, be very smart with your money, and have $30,000, $40,000 to put away. So clients, we've seen a good range of age from 30 to 50 years old. You could be older, but it's just you don't have as much time for your money to grow in that policy. You could be younger. The question is, do you have the money that you're saving at that time? Another thing to look at is clients who have maxed out their 401ks or their Roth IRAs, and they're looking for other vehicles to grow the money on a safe basis. So just a little profile of who we're looking at here. I wanted to do a quick sample of an actual client here. So just to say we're looking at a male, age 45. We're going to say he's relatively healthy. We're going to use what's called an index strategy, which we can go more in depth with just a little basis of it. It's based on the S&P 500. There's a cap and a floor. See, in the past, all we had to offer for a client who wanted to be aggressive was what's called a variable policy. Now, you're in the market 100%. The market does 20%, you're extremely happy. The market does minus 20%, you're very upset. So that's why indexed life insurance was created, to offset the market volatility of variable life insurance. So now with this policy, if the market does 20%, you might have a cap of anywhere from 10 to 14%, depending on the carrier you go with, but you also have a 0% floor. So the next year when that product does minus 20%, you're protected. So your clients are participating in the upside, but not the downside. What we're going to show here is a 7-page strategy. It's an overfunded strategy, and that way you're putting the most amount of money you can put into this contract. We're going to use a 7% interest rate. And we're going to solve for what's called a minimum death benefit maximum cash value play. And there's 2 reasons that we do that. When you lower the death benefit down to the minimum, it lowers your cost of insurance charges down to the minimum. What it also does is it lowers the agent commission down to the minimum. Sorry, Rod, I apologize for that. You're not going to make too much money off of this. But the whole goal here is to put as much money in this policy as possible, and that way the policy can grow, and it allows you to maximize your cash value for your retirement income. So let's go ahead and take a little visual here, a little look, and see how it actually looks on paper. So here we have the illustration. Let me scroll to the top here. So what we're doing here is we're putting in $50,000 a year, and we're going to put that in for 7 years. and then it buys us roughly about $1 million death benefit. So then what happens is that what we normally do with these illustrations is we show you what age are we going to probably retire at. So in this scenario here, we show the client retiring at 65. So we say, well, how much money can we pull out of this policy for 20 years? And if you'll look here, you'll see you can pull out roughly $75,000. And that comes out for 20 years, which buys roughly about $1.5 million of death benefit. So this is kind of the illustration here. I didn't want to show a specific carrier. We have access to 40-plus carriers. We can run, if you want to call Rod, we can run your personal information to see how it looks for you. The older the client is, you don't have as much time for the money to mature, so it won't look as good, but yet you can still have that cash value for retirement income. So that's kind of how that illustration works. Go back here to our presentation. All right. So here's a question that I get all the time here working for BackNine Insurance: long-term care. It's almost as bad as taxes these days because it's really a reoccurring problem that's happening consistently, and it's a big issue for a lot of people. I know me, myself personally, I've had it affect my family members, so it's a great challenge. So some of the things we've seen, what are the challenges of long-term care? Well, as we all know, it's extremely expensive. The price keeps going up. You're not necessarily locked in it. You change at any given time, especially here in California. The underwriting is very difficult. It's really going to be a pass or fail scenario. So there's no in between. Either you get it or you don't get it. Number one thing that I see is that you're not guaranteed to use the benefits. So it's use it or lose it. You could pay premiums for 20 years and not have anything to show for it. So what I wanted to do is talk about the benefits of using what's called a long-term care rider. Because now you have the ability to add onto your life insurance policy a rider. And the way that works is that when you do this, the cost can be up to 50% cheaper than having a traditional life insurance policy and a standalone long-term care policy. You can get up to 4% of your face amount. So whatever your face amount is, you can max 4% of the monthly benefit. Your premiums are locked in because this is a life insurance chassis. So as long as you pay your premiums on time, your premium is not going to change. And then no matter what happens, your benefit is going to be used. And that's really the key thing here. So just to give you a visual here, let's just say I had a $500,000 life insurance policy, and I go ahead and I add the long-term care rider to it. What that does is it simply gives me a pool of money of $500,000 for long-term care. If there is a long-term care need, it simply just draws down from the death benefit dollar for dollar. So for example, I had a year where I needed $100,000 and I pulled out of this life insurance policy. Well, after that year is up, I'll simply have a $400,000 death benefit. So it's really straightforward how it works. So you pay your premiums for your life insurance policy, long-term care rider. Again, it buys you a pool of money of the $500,000 for life insurance and for long-term care. You have access to 4%, up to 4% of that benefit. So the $500,000 policy, you could have access to $20,000 on a monthly basis. And then any portion of that benefit that's not used for long-term care, you would have access to for cash value if you wanted to pull some cash out of that policy, as well as the death benefit. So we call that three-pronged approach that we're seeing. And again, what I mentioned before, the old kind of insurance versus the new kind. This is the new kind of insurance, and we're having a lot of success with it because it makes a lot of sense for clients. So if you want to look how that works, you can always give Rod a call. You can ask for a quote, and we can help kill two birds with one stone with your life insurance, your long-term care, and the third bird is the rider with the cash value as well. So there's a lot of options here for you. What we did here is we have a few pieces that Rod's going to use to help you, the client, to be able to be efficient with managing your portfolio. So see here, let's go ahead and go to these pieces now. Sorry here. Okay, so the first thing we have okay. I apologize. Oh, I apologize. Here we go. Okay, so the first thing we have is a fact finder that you can go through with your clients, for you. So Rod will go through you step by step just to see, break down your income and see how much insurance you currently need right now, based on your income, based on what your needs are. It's a real simple needs analysis that you can go through here, and it'll take 10, 20 minutes sitting with Rod, and we'll figure out exactly what your need is. It's a real simple form to do, and I recommend you go ahead and take advantage of that. Let's say you currently have some life insurance in place right now. Rod offers what's called a complementary insurance review that he can do with you step by step. Now, I know that you don't do this, but there are clients who buy insurance and then it sits there in their closet for 20 years and they have no idea what they have. But I know you're not guilty of that, though. So all you have to do here is Rod will sit with you and fill out this top section, the carrier you have your insurance with, just a few basic things, your insurance, your policy number, and sign. And what that'll do is that'll allow Rodney to take your information, submit it to the carrier, and get an in-force illustration of what you currently have right now. Now, based on what you currently have, we can give you some options. So let's say you're looking for the same death benefit, but you want to have a lower premium. Mortality tables change in this business. People are living for longer. People are healthier now. So we can show you some options based on what your goals are. So let's say you're looking for the same premium, but you want a higher death benefit. Well, we'll do the analysis for you, and we'll research it and see what's out there with our 40-plus carriers. Now, we see this one a lot. Let's say you want no additional premium with a paid-up policy. Let's say you have some cash in the policy, but you just don't want to keep paying premiums. What we'll do is we'll show you an option where you don't have to pay any more premium, and you'll have a paid-up policy. We see that one a lot. This is a really simple policy review form. We strongly recommend that you sit with Rod and take advantage of this. It's a really simple way to operate here. The last thing I want to show you is if you're a business owner, so if you're listening to this call and you own a business, Rod has the ability to offer you what's called a complementary business valuation. This is a really simple thing to do. A lot of the time, people to get their business valuation wrong, and they already have insurance in place. We want to make sure it's right for you. Worst thing that happens, you do the evaluation, you figure out your business is worth, you think it's worth $5 million, and ends up being worth $7 million. Now we have to redo your buy-sell agreement. We have to redo your insurance that are in place, your key man policies, whatever it might be. So it's a really interesting thing. It's a complimentary service. What I've noticed is it can cost thousands of tens to hundreds of thousands of dollars for this, and Rod can offer it to you on a complimentary basis. So if you take a look here, all you need is 3 years of tax returns or 3 years of business financials, and we can go ahead and get this done for you. It takes about 7 business days to get done once we receive the information back. But from there, it really helps you to make sure that your business is evaluated correctly and that you have a good overview of what's happening in your business. And that's called the business valuation. So I'm going to go ahead and wrap this up here. I want to thank you very much for listening to the Tax-Free Retirement webinar. Rod wants to mention one more thing to you, but again, I appreciate your time. Please do not hesitate to give him a call if you have any questions or any concerns, okay? Go ahead, Rod.
Again, thank you for attending the webinar. Please send me any feedback. Let me know if you found this to be beneficial. I'm planning on doing more webinars in the future regarding annuities, long-term care, and other financial products that may benefit you. Again, thank you for attending. If you have any questions, certainly let us know.